of course, for most of the time, I just assumed it was over, and we'd have to, figure out how to wind it all up. But once a lot of the sort of chaos of it had sort of, moved into history, I think we just had so much support from people, and I talked to the team and asked them what they wanted to do. Do you people want to stay with us or move on, or what do you want to do? And everyone sort of said, we'd probably stay in the industry. So, okay, what are you going to do in the industry? And so I'll probably work on, all our expertise is in this type of thing, so we're going to have to work on this again. And we just said, if we're going to do that, would we work together again? Well, yes, probably. Like, well, do we need a new project then? Wouldn't it be weird if we just collapse this one and started Euler 2 or something? Why don't we see if we can stay together and make a go of it? And we were fortunate. Our investors and people were very supportive and said, look, we're ready to back you again and support this if you guys are ready to go again. So
wow.
Yeah, at some point we just said, let's go for it.
Here we are with Michael Bentley, co-founder and CEO of Euler Labs. Mike, it's so great to have you here on the Defiant Podcast. Welcome.
Thank you very much for having me. Yeah, excited to chat.
Yeah, likewise. So Euler has had a really fascinating story, a comeback story. You were exploited for a huge amount of money in 2023,
yep.
And now you've recently broken through $1 billion in outstanding loans, with up from less than 50 million last year. So it's just been a really interesting comeback. So we'll get to all of that, but I'd love to just start from the beginning. Learn more of your background, what led you to crypto, and then what led you to start to found Euler.
Yeah, my story. I mean, the first time I ever heard about crypto was probably 2015, and I was trying to do a side project with somebody. I was a research scientist finishing my PhD, and me and a friend were looking for stuff to do, and he told me about Ethereum. I initially was a bit of a skeptic, I would say, and so I kind of dismissed it. And then I came back in 2017. There was a bull run at that time, and of course that grabbed everybody's attention. It was all in the news and everything. And I thought, maybe there's something more to this. So I got involved and started, downloaded Coinbase and everything, and then started playing around really. And at that time there was primitive dexes and things around. There was Ether Delta and IDEX, and I started mucking around on those things and learning how to code and learning some of the code base and things, and having a good time. I built some bots and made some money and lost some money. Just hacking around in the system, and it was it was really fun. But for the next few years, nothing really happened. And then in 2019, early 2020, I was working as a research scientist, doing mathematical modeling of populations and things, and DeFi emerged, or the early foundations of DeFi started to emerge, things like Uniswap and Compound, and they started to get me really excited, and I started to think, how can I build something in this space? So it really started with looking at Compound's code and their product actually, and trying to think if there's some way I can innovate on this and make it more open to different types of assets, or change the way that interest works and make them more decentralized. So that's really how it got started in my interest in the space. And then from that, I participated in a hackathon. I met my co-founder, Doug, who's a computer scientist by training. We worked on something together, built this primitive, I guess what would have eventually become Euler for the submission in the hackathon. It went very well. We ended up winning.
Which hackathon was it?
Shout out to Encode and I think it was called the Spark Hackathon back then. So it was a collaboration of different universities in the UK that were participating in the hackathon. And we ended up winning, and then from there, I mean, the pandemic was raging at the time, right? This was like 2020, so my day job, I was kind of not doing what I was normally doing, I would say, sort of being asked to, all the labs were closed down, so I was at home, just had my daughter at the time as well, so I was spending a lot of time with her, and so I had a lot of free time to work on this, and I got an offer from some venture capitalists saying, would you like to turn this idea of yours, this hackathon project, into a fully fledged business and try and grow it from here?
So what was the initial kind of innovation of that hackathon project?
So we had two things. One, I think at the time, a lot of the early lending protocols were focused on just lending and borrowing of a handful of crypto native assets. But there was a lot of tokens emerging around that time, a long tail. And so one thing was, can we extend what Compound are doing and extend it from 4 or 5 assets and make that open up lending and borrowing for all the assets? How can you collateralize anything and use that as to take out loans? So that was one of the challenges we want to address. The other one was, I do a lot of sort of maths by my day job, I suppose, and I had this idea about using something called control theory to see if you could make interest rates set themselves without having to have some central controller coming in and pushing buttons like we have with central banks, setting the interest rate manually over time. I was curious about, could you just let the system itself set the interest rate and make it more decentralized, I suppose. And so that was, quite an interesting intellectual challenge at the time for
Totally.
me.
Yeah, I've always been curious on why, or I guess like surprised that that Maker actually kind of decides on its interest rates.
Yeah.
I for some reason, like when I first started looking at Maker, and everything or so much of it is automated, but not interest rates. So I think that's an interesting problem.
Yeah, it is. I mean, Maker has it's more like the central bank in a way, and I think it's kind of hard to set. You realise when you get into the weeds of it that it's really hard to make interest rates work in a self-controlled, automated manner. It's somewhat easier on lending protocols where the interest rate is guided by what percentage of the pool has been borrowed. And effectively, in that scenario where you have like a finite supply of something and you say what percentage has been borrowed of that finite supply, it turns out the answer is that you can let these things set themselves and you can automate it and decentralize it more. There are obviously trade-offs to doing so, and there's some nuances there, but it's definitely possible. And Euler has had these kind of interest rates. They're present on other money markets as well. But when it comes to Maker, I guess the key challenge is that there's no finite supply of DAI or USDS as it is now.
Right.
And that means targeting something. It's sort of like that lack of a constraint on that supply makes it harder, I would say, to set the interest rate. So
right.
Yeah.
So the key thing that the key innovations that you were working on are the long tail of assets, a lending protocol that allowed for that, and a more like market-based, like automated way of setting interest rates. And so, so you took kind of these VCs up on their offer and went and built it?
Yeah, that's right. And then the rest is history, as they say. I mean, that was in September or August 2020, really at the heart of DeFi summer, as we called it back then. Obviously, there was just explosive growth in the industry around that time. Lots of projects launching, and we were one of them that sprang out from that period, I suppose. And then eventually, obviously, you go to market and you change things, and our goals and ambitions changed quite a lot as we started to. As I think Euler V1 went live in 2021 sometime, and then you get feedback obviously from the market itself and people, users and so on, and things definitely changed in terms of priorities, but that was the original ambition, I think.
Interesting. Okay, and then I guess like there's like, to me, like the phase 1 of Euler, which is like since launch and then up until the exploit. Yeah. Can you go through like how the protocol developed in that time? Like you mentioned, like some of the priorities changed. Yeah. And then how big did you get like right before the exploit?
Yeah, I mean, whenever you bring, I guess, any product to market, you then start getting real user feedback, and we definitely got plenty of that. I think, I mean, in the early days, one of the ways that we innovated was by to enable lots of assets to be listed. We wanted to build on top of other permissionless infrastructure in DeFi, and that was one of the big innovations around there was Uniswap. It was a version 2 of their protocol, and they enabled people to create swaps for any type of asset, right? So you've got all these countless pools emerging, and what's interesting about that is that then from those pools you understand the relative value of assets. And from those relative values, you can then potentially use that pricing to enable collateral debt relationships to emerge. In a lending protocol on Ethereum, you want to guarantee effectively that your collateral is always worth more than the debt. If that's not the case, then there's no incentive to repay. So you have to be able to price the collateral in the loan and the debt in the loan and make sure that one's greater than the other. And that the pricing is accurate and fair. We thought it would be cool to use Uniswap as a pricing mechanism for collateral debt relationships. And I would say it worked quite well for a time. But we realized, of course, when we brought it to market, that there are subtleties to that. Uniswap prices, can be manipulated by bad actors who try to inflate the price. Maybe they want to inflate the price of a collateral so that they can borrow more against it than they really should be able to, and that kind of thing. So there's a lot of learning around that time about, a lot of experimentation in DeFi, I suppose, about what worked, what didn't. And we launched with these Uniswap based pricing systems, and then over time, I think we moved away from those and tried to use alternative pricing mechanisms that were more robust, I think. I wrote some research articles about how these things could be manipulated and looking at the extreme scenarios, how much money it would cost and that kind of thing. So it was a lot of sort of security analysis off the back of just this whole new system and figuring out how it works. It was also apparent as well, we just kept getting feedback from users that wanted different kinds of things. We realized that lending and borrowing is a very complex space with lots of different design directions you can go in. Some people want low risk, low yield opportunities. Other people want more exotic opportunities that maybe where they take on more risk, but the yields end up being higher. People want things isolated. Some people want things that are more permissioned or permissionless. There's just a huge design space there. And I think Euler V1 as a whole, it was built around just one type of idea, and we realized there's so many more ideas out there that people want. We started to try to build, to think about how we might design a V2 of the system. In terms of how it went as a protocol, it was much loved, I would say. We launched in the competitive marketplace with other lending and borrowing protocols around at the time. Obviously, Compound was one of the things that we had most admired. That had launched and was doing very well. So Aave had kind of become more prominent around that time. But Euler kept growing, and I think going into the exploit in 2023, I think the total deposits were at their peak, maybe 700 million. And there were lots of interesting events before our exploit in DeFi that helped dampen interest in DeFi. I suppose there was the Terra Luna thing and FTX and all these others. And so I think by the time of the exploit, total deposits were around 400 million, and that was in 2023.
So can we get into the exploit?
Sure. Yeah.
So the exploit was one of the biggest in DeFi. It was almost 200 million lost. So how did that happen?
Yeah, it was. It's a very long story, but the short of it is obviously Euler. We were known as a team that built things slowly. We took our time. We got lots of audits. We had the largest bug bounty for a lending protocol in the space at the time. So we took things very seriously. But even after all those audits, we got a bug bounty report from one user a long time before the exploit happened, suggesting that there was a way to front run the very first deposit into a brand new pool.
Okay.
And you'd be able to maybe take more funds from that than you should. So one user would be affected by this per pool, and it would be the first user potentially. It actually turned out to be a common kind of exploit that the other protocols were maybe vulnerable to as well, and it's considered something that you should fix, a high, because it's a loss of funds. So we got this bug bounty, we paid it, we were grateful. We went to our auditors and security partners and said, we've had this thing, and they said, okay, let's deploy a fix. So we came up with this solution, which was effectively to prevent the front running. The front running was caused by a lack of an exchange rate that wasn't initialized basically when the new pool's formed. And so we thought, well, if you want to initialize an exchange rate, let the very first depositor, they will deposit like 1 billionth of their asset initialize the exchange rate, and then their main deposit will happen. So they effectively donate to the reserves some, that's what the function was called, donate to the reserves, some assets, initialize the exchange rate, and continue. Anyway, that fix was audited, it was deployed, and the protocol then continued for many months after that. Unfortunately, what we weren't to know at that time, what we missed, was that the new function that we'd introduced, donate to reserves, opened up quite a sophisticated vulnerability in its own right, which would be the cause of the critical vulnerability, which allowed far more assets to be stolen. So it was a very unfortunate circumstance. Ultimately, somebody figured out that you could use donate to reserves in a sort of clever way, along with the liquidation system, so that you would lose money yourself by donating to the reserves, but you would gain an ever so slightly more amount of money through another account that you were using. So one you would have two accounts. One account would be losing money. One account would be making ever so slightly more money than you would lose. But if you loop that, and it's a computational system, you just loop it and take advantage of that discrepancy, and that's effectively how they were able to take all the funds from Euler by using this donate to reserves function that had been introduced many months prior.
I'm sorry to have to, ask you to relive what must have been, I don't know, probably the worst time of your life, but
yeah.
I can't imagine how was kind of waking up to, or like finding out that your protocol was being exploited by this amount,
Yeah.
Like, how did you find out?
It was horrific. The timing couldn't have been much worse, to be honest. My son was born on the Thursday, late Thursday night, and over that weekend, the whole industry was rocked by this depeg of USDC. So over the entire weekend, I spent the weekend not with my son, but handling a bunch of work stuff, because USDC was depegging, which obviously is a significant event for the whole industry, but also mainly lending protocols. So everybody was on high alert, but by Sunday evening it appeared that USDC was going to be fine. There was some kind of agreement made, Monday morning I woke up expecting to start my paternity leave. My wife and I were looking forward to spending time with my son, and my mum came round to the house to take my daughter for the day and go take her out and give her a nice time. And it was 9 o'clock, and so my mum was in the house, just literally about to take my daughter, and I heard my security alarm going off. My first assumption was, of course, this will just be the USDC thing again. I thought it's probably reared its head, something's happened in the night, a deal's fallen down. I was like, okay. It was alarming, but I was thinking this is probably going to be okay. We just need to work through this. And I went up, and just, of course, the first message I saw was that we were being exploited. And and so it would be that's how I found out. It was true, very, very
How shocking, awful.
Yeah.
And was it was the 200 million just disappeared, or was it something that was continuously being drained? Were you able to even try to stop it at the time, or were the funds just gone?
No, it wasn't instantaneous. It played out over several minutes, I would say. So it was over a short period of time. And interestingly, I can't get into the technical details here, but some of that time actually then gave us clues as to maybe who'd done it and what's happened. There was there was clear flaws in the execution plan of the exploiter, because if they could have taken it all in one go, they would have done. And it turned out that process had failed. But unfortunately, it still happened too fast for anybody to do anything really about it. And and then what proceeded after that, of course, was when a protocol has been drained of many of its assets, but not all of them. There's then a big scramble, of course, for other people to try to get value out any value that's remaining. So there wasn't just an exploit. When these things happen, it affects lots of positions and parties and everything. And so there was a lot more that then followed on from that, which played out over maybe another half an hour or so. It was very chaotic, but it was impossible. There's no obvious solution at that point to, when more than half the assets in the protocol have gone. There's these ones remaining, and it was pure chaos.
Oh my God! No, I can't imagine.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
After that, I think, as I understand, the hacker actually returned some of the funds. Like, how was the process of like trying to recover funds, like figuring out what had happened, who did it, like negotiating with the hacker?
Yeah, so we collectively as a team, we started to immediately build a picture of bigger picture as we could about potentially who might have played a role in this, right? I think by the end of the first day, so by that evening, we probably already had like 10 to 15 potential candidates. So we did a lot of analysis, like as a team. We all split up and got as much data as we could from a variety of different sources, both on-chain data, off-chain data, looking for any evidence we could find about who might have played a role in this, trying to find signal in amongst all this noise. And yeah, over the course of the next 3 weeks, then 3 to 4 weeks, I think it was, a lot of crazy things happened. We ended up having lots of red herrings, people that we were convinced would be, guilty of this, but then turned out not to be. There were people that had forked the protocol and spent a lot of time on certain areas of the code, for instance, that and then they were deleting stuff on their profiles, things that just looked very suspicious, but turned out to be, red herrings. They exploited themselves. I mean, they were, behaved a little erratically, and turns out to be interesting signals in the early, like I said, in the early phase of this. It was carried out with less efficiency, let's say, than it could have been, and so we could decompile the attack vectors and start to get an indication of the type of attacker this was. We knew early on that it probably wasn't, North Korea. They're one of the people that prime candidates whenever there's a big attack. People expect it's possibly them. So we knew quite early on that it probably wasn't. This was more likely, an individual, and obviously there's a lot of information that you can gain from that, and it raises the prospect of catching the individual, getting the funds back. At some point, they started to I guess, try to launder the money, and that, somewhat unsuccessfully, and then they started to attract the attention from other bad actors in the space, I would say, who were seeing them as a bit of a target. And through a variety of different means, we managed to establish contact with the person. And even at that point, though, that things weren't very promising, because they still kept trying to play lots of games. At one point, they pretended there were different people involved, and I managed to talk to them personally at some point. And
so you know who it was? Is it public?
It's public, yeah, I'd say so at this point. I mean, it was, yeah. There's they later.
Who was it?
They later introduced themselves. I don't want to name the person, but I mean it's out there if you go looking. Yeah, I mean.
Was it someone from your team?
No,
okay.
no, definitely not. It was a young man who had a history in computer science, I suppose, and was a young man that was very interested in exploits and things. From talking to him, I gathered that he was like an admirer of people that carried out exploits. He found it kind of exciting and exhilarating, and found the opportunity on Euler, and I think it was hard to discern his motivations, I would say, honestly. He was an interesting character. But yeah, I thankfully managed to establish contact with him, and over time build some kind of trust and a weird relationship with him, I suppose. And we just had lots of odd moments. At one point, I thought I was going to have a heart attack, because I was just so worn down. I was just getting absolutely no sleep, and I said to my wife, my chest feels really tight. Yeah, it was like awful. So I went to the hospital just to get checked over and everything. And I was sat in the waiting room, and then he started messaging.
Oh my God.
And I'm sat there in the hospital waiting room on a laptop, like, you know, my laptop also had like very little battery as well, and like trying to message this guy, and then it was just the most insane moment. I'm like literally on this laptop, and then an alarm went off because somebody else in the room next to me was going into cardiac arrest, and I just like literally
what an insane
it was just like
moment.
wild. I was just like, this cannot be real, what's happening right now. But then he was going through his own, like he was questioning his own actions and motives and starting to turn, and so yeah, he was also feeling, I think, uneasy and unwell about everything, and so then yeah, I was just trying to talk to him and try to humanize the situation, find some common points of you know, agreement between us. And then yeah, several weeks later, in dribs and drabs and with some wild events in between, he eventually ended up returning not just some of the money, but basically all of it. We got 240 million back out of around 200 million was stolen, and but he'd converted the stolen funds into ETH, and ETH happened to rally at that time. So
you got more back than what you originally stole?
Around 40 million more back.
And he didn't keep anything?
He did keep a little bit. He had some funds which were which he'd already laundered, which were hard to retrieve.
Do you know how much he made?
Yeah, probably a few $1 million.
Okay.
But the protocol itself had its own funds in there, so effectively they were the protocol's funds. Protocol lost more money and just took all the loss. So anything that was returned was given back, obviously, all to the users.
Oh, that's amazing! I didn't remember that you had recovered more than he took.
In dollar terms, yeah. I mean, it was complex,
Yeah,
right?
right.
It's just he just turned it all into ETH. Like, it's a common strategy for an attacker because it's more of a permissionless asset. It can't be frozen and such like. So that's why he did that, I suppose. But yeah, I mean, in the intervening period, just lots of weird things happened. There was, you know, a suspect that turns out not to be true, and it turned out actually he was from the same town as the guy that had done it. So there was lots of signal that maybe.
Wait, you were from the same town that from the hacker?
There was another person involved.
Oh, someone else that you suspected.
Yeah, that was also from the same region, and there's so many crazy points. For a long time, we didn't know the identity of the attacker, and we're having to sort of work through negotiations with them not knowing whether we knew, and we didn't know if they knew, and there was just lots of game theory involved.
But in the end, I think it's remarkable that once you found out who it was, that it was more of like just like a personal relationship between you and him, and just, you know, trying to get to his, like, you know, like more human side and get some empathy and compassion, and you ultimately achieved it.
Yeah, I think so. I mean, he was a very complex person. I don't know how much he empathized with the situation. He would swing sometimes between showing a lot of empathy, and other times would be then asking, no, I want to keep all the money, or I want to keep a large sum, or he would say, start to pretend that there was other people involved, and like start to move money to other wallets and be like, oh, somebody else took that. It's like, oh. So he was a very complex individual, and it was a really, really tough negotiation. I'd say lots of complex messaging, and it had to be navigated very carefully. I think one thing he did, which was incredibly strange, but maybe in the end was actually helpful, was he donated some of the stolen assets to a known address that was associated with North Korea that had been identified by US agencies as links to those. I suppose that was kind of a bluff. It was like, oh, look, it's probably just Lazarus or whoever. But of course, we sort of knew already that almost certainly wasn't the case. And so that bluff gave us more information and so on helped our investigation. But then what it did do as well is it then alerted some other people to then start messaging him and start sending him messages saying, we can help you launder the money. But we could see those messages, and we were able to say, you know, start to work with him and say, look, those messages these aren't your friends, right? You are in a lot of trouble here if you start interacting with these other people. Like, we're the best way out.
You probably got super scared.
I hope, yeah, I think so. I said, like, I hope you realize we're the best way out of this, because there's no other good angles here. You are going to be under living a very stressful life.
So what was the deal? Was he kept a couple of million, gave back all of the rest, and you didn't call law enforcement?
That's effectively, that's what he was asking for. I mean, when you do something like that, obviously law enforcement are involved, and there was a lot of interest in this particular case from various law enforcement agencies.
Oh,
I mean, we just said ultimately, like, what everybody wants from this is that you just give the money back. Once you do that, then this becomes much less interesting from everybody, because everybody's got stuff going on in their lives. They just want their money back. So we just kept reiterating that point over and over and over again. And working very carefully on his emotions and our emotions and everything. And eventually it happened. But there's so many even wilder, weirder things in this story that just played out in the midst of it. Other interesting characters that showed up claiming to take credit, and all sorts of weird stuff happened. Yeah,
we'll get into all of the details in my DeFi book.
Yeah, you could write an entire book about this thing. It was just bizarre.
Yeah. And so, how did you manage to refund all of your users?
I mean, it was just use effectively like common accounting techniques and try to calculate what's called people's NAV, net asset value at the time of the exploit, and return based on relative to NAV effectively, because as the assets came back, there was some. I really can't. The amount of times he split the funds up and converted some to DAI and then some to USD. So it all came back in weird ways, and obviously took advice on what you do in this circumstance, because there are lots of options you could go down. They all have trade-offs. Some people are like, oh, go and buy back the assets on the market. It's like, but they've all changed in prices since then, and there's no easy way. There's no perfect solution there. I would say it's a very complex thing. But just try to follow best practices, and then opened up a claim page for people so that they could go and put their address in. We developed the tech for this really quickly. The team worked incredibly hard during that period. We were working just non-stop to get this up and running as fast as possible. Because the whole time, once the funds came back, of course the markets are volatile, and imagine if ETH had just
tanked,
dropped 90% or something, it'd be devastating, right? So it was really, really, really tricky, very, very hard. And the post-exploit, that period lasted several weeks, but then there was all this stuff to process. There was all sorts of other things, legal elements that played out over many months after this. So it was incredibly complex. I'm sure you can imagine.
I can imagine. Yeah. So in that time, as kind of the fallout from the exploit, what were you thinking would happen with Euler? Like, did you always know that you'd continue, or were there times where you thought, okay, this is done?
No, I mean, I just thought it was done. Yeah, for a long period. Yeah, of course. Yeah, I mean, it's. I spoke to friends, family, investors, people in the industry. We got loads of support from people in the industry, giving advice on what to do and giving us support. And I'd say for most of the time, I just assumed it was over, and we'd have to figure out how to wind it all up. But once a lot of the sort of chaos of it had sort of moved into history, I think we just had so much support from people, and I talked to the team and asked them what they wanted to do. Do you people want to stay with us or move on, or what do you want to do? And everyone sort of said, oh, well, we'd probably stay in the industry. So, okay, what are you going to do in the industry? And so I'll probably work on, all our expertise is in this type of thing, so we're going to have to work on this again. And we just said, oh, well, if we're going to do that, would we work together again? Well, yes, probably. Like, well, do we need a new project then? Wouldn't it be weird if we just collapsed this one and started Euler 2 or something? Why don't we see if we can stay together and make a go of it? And we were fortunate. Our investors and people were very supportive and said, look, we're ready to back you again and support this if you guys are ready to go again. So we at some point we just said, let's go for it. We had so many ideas and so many cool things we've been building that just were totally underutilized. Euler V2 was pre-planned before any of this had happened because of all the things we'd learned, you know, from as we discussed, from going to market and hearing feedback and stuff. So yeah, a lot of all that was already pre-designed or like in a, you know, early phase of development, I suppose. And we just thought, well, why don't we give it a shot?
Crazy. How much time passed from the exploit to when you decided to launch V2?
Months probably. Yeah, there was even some discussion, of course, of like just launching V1 again. Some people were really encouraging that because the protocol itself was excellent, and incredibly and very frustratingly the fix to this exploit would have been a single line of code. It was a single missing check in this function we mentioned, donate to reserves. It's now kind of famous that was missing. So adding that single check would have ultimately made the protocol safe again. So some discussion around that. But then we just said, you know, if we launch V1 again, then we won't have as much time to work on V2 and tackle all these other interesting problems. And I think everybody was obviously exhausted and felt like spending some time going back to just coding and not having to have, you know, public facing thing was probably for the best of everyone. I think everybody needed it. So
it was like a turn of a page.
Yeah, it was like, okay, well, yeah, it's always hard to deploy a new protocol when you've got an existing one anyway. So I thought, we all agreed, like, why don't we just work on V2 and start there? And we knew it would take many months of work and everything to get that live. And indeed, it did. It took probably even longer than we expected. But yeah, it was, I don't know, 3-4 months after the exploit that we started in earnest on the new project, I'd say.
And when did you launch V2?
September last year, I think. Yeah. And
now it's already at $1 billion.
It's $1 billion in active loans. It's got about 2.25 in total deposits. Yeah, it's been I mean, most of that's come from the turn of the year as well. So the first few months were incredibly difficult. Nobody was that interested. Actually, on launch, we were so excited because we thought we'd spent so much time on anything. We were so proud of it, and we thought the tech was incredibly strong. And but of course, it's really hard at that time. Everybody's doubting. Everybody's saying, yeah, nice try, but it's, you know, we appreciate the effort, but it's not going to happen. That was kind of the consensus. And we got some feedback as well that the new product was it was a bit more complex, and the UI needed some tweaks and things. So the team were, I would say the morale was a little low during those first few months, but I encouraged everyone. So we've got to give this a shot. So we fixed up the feedback we'd got, and slowly but surely things just started to change. And
what do you think prompted kind of that change in direction where like people were able to trust you again, or at least like were incentivized enough to use Euler?
I don't know really. I mean, there's probably like a collection of things. I mean, Euler V2 is built in such a way that other people can build their own. It's built as this kind of developer's kit, I suppose, for building credit markets and now DEX markets and things. So rather than being a product in its own right, it's just like a kit for building products. And in the first few months, we just really couldn't, we couldn't persuade people that it was worth building products with. So yeah, we tried to showcase that and develop a few things and just like work and the kind of business development side, I suppose, and going out and like just meeting people and showing people, yeah, you've got a problem here that you can't solve, but Euler can solve it for you. And I think once we had a first few of those kind of things emerging, then it became apparent, there's stuff you can do with Euler that you can't do with other platforms, and there was that early sign of just real product market fit emerged.
Who are like the main builders?
A variety of people. I mean, there's curators, we call them risk curators, because typically they connect together the components of the kit and they make either very simple credit markets or sometimes more complex ones. The simplest ones just look like simple collateral debt pairs, and they can either be immutable or some of them are governed and have compliance checks and other things wrapped around them. There's these hooks and things. Other ones look almost like mini instances of something like Aave, I would say. They're a bit more complex. They have more assets included in more variable collateral types. But yeah, some of the bigger curators. There's RE7 and Gauntlet and K3 and MEV and Apostro. There's one of the bigger markets was built by another team called Usual. There's all sorts of people, and they all build for their own reasons. And we try to be agnostic about the products, because that's our point. The whole point of Euler was to build the infrastructure and then let people be creative. We often don't understand the wants and needs of the market. It's like as we discussed earlier, there's just many different opinions about what a credit market should look like and what services people need. And our goal is to just build the infrastructure that enables all of those to be satisfied. But we rely on other builders, I'd say, to come in and develop their own solutions, build their own bespoke products for particular communities and user types and things. So there's a very wide variety of things being built.
What if sending crypto felt more human? Pulse just launched Red Packets, a new way to gift tokens with meaning. It's gasless, gamified, and claimable inside group chats only. Think airdrops meet social cues on-chain. Backed by smart wallet tech and live across major L2s, Red Packets turned communities into microeconomies of gratitude and growth. No seed phrases, no friction, just connection with value. Check it out at pulse.social.
I think your strategy is very similar to Morpho's.
Yeah, there's some similarities there for sure, yeah.
How do you differentiate between them?
I think we have a similar philosophy at a very high level in that regard. They're also kind of an infrastructure play trying to build, and it's lending and borrowing as well. I think in terms of why we've managed to find a niche is we have different opinions on how those things should be designed. Morpho, I guess, prioritizes simplicity above all else, and there's obviously an elegance in simplicity, and there's something I think quite nice about that. Euler's kit, I suppose, our like infrastructure play is built around enabling things to be flexible, and so that means that if you want to build simple things with the Euler development kit, you can go in and build Morpho-style markets. But if you want to build something more complex, like an Aave-style market, you can also build that. And so it's that flexibility, I think, that differentiates us most, is you can build Morpho using Euler's kit, but not the other way around. And with that, that's probably where people come to build things on Euler that the markets don't exist, say on something like Aave, and they can't build those things on Morpho. So they then come and use our kit and try to innovate themselves and build different types of products, I suppose. And that's the main differentiator, I would say.
Right now, the DeFi lending market is at a near all-time high in terms of deposits.
Yeah.
Around 69 billion. So what do you think will spark the next wave of growth? Will it come? Do you think like it'll be more institutional players coming and building on DeFi?
Yeah.
Or maybe DeFi is not ready for that yet and will continue to be more crypto native?
No, I mean, I think you hit the nail on the head there. It's definitely going to be institutional plays. I think there's a lot of Web 2 interest, fintech interest, traditional finance interest in building on DeFi or at least using DeFi Rails and the technology we've developed, because it's more efficient, because it's more transparent, it's more composable. I think, lots of these things are, lots of the people coming into the space are finally sitting up and taking note that there's actually something very cool about this. In the early days, it was mostly crypto natives. The main use case, I'd say, for lending and borrowing markets was just people would deposit ETH and they borrow USD, and they wanted to do that because maybe they didn't want to sell their ETH, or some people wanted to speculate on the price of ETH, so they then use that USD to increase their exposures. And that was the main use case. And so like lending and borrowing markets would be very cyclical in terms of their deposits. They go up and down, and it was very correlated to the sentiment, I suppose, in the wider market. I think that's changing a lot. The technology is now being used to provide a wider range of like products and satisfy different user needs, I'd say. And a lot of those are more related to stablecoins, and obviously the surge in interest in bringing stablecoins to market in DeFi. But yeah, it's we're getting a lot of calls and a lot of interest right now from some significant players in more of like a fintech space, I would say, than the traditional crypto native types. Yeah.
Oh, interesting.
Yeah.
So, yeah, because when we talk about institutions, it can mean from exchanges to fintech to traditional banks, and so you're seeing that interest, at least from the Euler side, from like Web2, like traditional fintechs.
Yeah, I'd say that's probably. I mean, obviously we saw the Robinhood thing yesterday. Yep. I think you're going to see a lot more companies that are very recognizable fintechs moving into the space and starting to utilize the technology. That will probably be the first wave. And I think with some of the regulatory changes and like warmer environment for that, and it's now more of a regulated industry, especially in Europe. They've made progress there. There's some signs of progress in the US on the regulatory front. I think with that you'll then start to see also more adoption from more traditional traditional types as well in traditional finance, like banks and things. I think we'll be more open to adopting the technology. Yeah.
So we've obviously spent most of the time talking about your lending protocol, but you also have a DEX, and you recently launched a stablecoin product. So if you can, like bring all those things together and kind of describe your like bigger vision for Euler. Yeah,
I think the earliest products or protocols in DeFi tended to be quite inefficient, and that's been one of the criticisms I think from people outside, is that it's kind of cool, but it's still very, very inefficient. Mm-hmm. One example of this is when people do deposit assets into a traditional, some of the older versions of Uniswap, the assets just sit there and they're used very unproductively until a swap happens. When the swap happens, then they earn some fees and so on, but it's just very very unproductive to deposit assets and just leave them sat there. If you've got USDC sat around that's not servicing swaps, it should probably be earning yield somewhere. And of course, in traditional finance, nothing works like that, right? They don't literally, when you have order books on exchanges, and the assets aren't literally sat on the order book, they're sat in some other place, and things they're productive, and then things, the accounting's done afterwards in retrospect, and then things are distributed and moved around, of course. EulerSwap aims to address some of the major inefficiencies in exchange markets by operating on top of the lending and borrowing platform. So that the lending and borrowing platform is the foundation for EulerSwap. By default, assets earn yield, or optionally earn yield, I should say, in the lending and borrowing platform first and foremost. And then if swaps happen, the liquidity is used just in time to service those swaps. So it operates a lot more efficiently, a lot more like how exchanges would work in traditional finance. To give you an example of just like some of the scale up in efficiency, we've not even launched the product yet. I think there's only $3 million in the pools, but Euler's already by volume. Someone showed me yesterday with those 3 pools and $3 million, it's doing as much volume as it's the 4th biggest exchange on Ethereum already. Oh wow! Which is pretty insane. Scale up in capital efficiency. The other big innovation in EulerSwap, which is something that people have been crying out for years since I very first entered the industry, was that when you deposit assets into the DEXs, another way to make them more productive is to basically borrow against them, to basically collateralize your deposits in the DEX, because it's a valuable asset, and then use that so that you can borrow against it. Maybe you want to hedge some of the risk, or you want to borrow the asset and borrow something and then use it in another opportunity somewhere else, or reinvest back in and create deeper liquidity in the pool itself. And because EulerSwap is built on top of the lending protocol, if the assets you deposit into the vaults are in vaults that allow collateralization of those assets, you get that functionality natively out of the box. And so people can borrow against their deposits in the swap protocol and use it for a variety of use cases. So with extra lending and borrowing yield and this just-in-time liquidity function, as we call it, EulerSwap is vastly more capital efficient than any kind of DEX we've seen so far in DeFi, I think. And going to be very excited to see that growing alongside Euler. Okay, so it's like building different DeFi primitives that kind of fit and like work well with each other, like. Yeah, it's in the early days we used to talk about composability and money Legos of you know, it'd be you know, Aave and Uniswap integrating, and that's obviously worked somewhat well in the past, but it's actually quite clunky. You know, you end up in some ways. You know, I used to really be a huge advocate for this kind of thing, but it adds extra like risk points because the two protocols weren't necessarily designed to fit together. So you can maybe fit them together, but you know, when people have tried to borrow against LP tokens in the past, those LP tokens are kind of, it's a little bit risky, I would say, to price those things and to figure out how to collateralize them, and it's a little inefficient to move them around DeFi, you know, between protocols. You might end up paying fees on multiple platforms at once and so on. And yeah, this is composability, and but it's you know, coherent composability between two things that were designed to work perfectly with one another.
I see.
Built by the same team, and hopefully with that we get more of an efficient and effective and secure market.
Okay, and to wrap up, just, you know, going back to your whole comeback story. Yeah, wondering kind of what any lessons or advice that you'd want to share with founders going through something similar.
I mean, there's just never there's always more you can do on security, and just obviously you just have to keep pushing. Always do as much as you possibly can. That goes without saying. I mean, we've always advocated for that, but it's a very, very difficult industry to build in. You are very exposed. The code is public and so on, and everybody's still learning about honestly what the best practices are, and that's something we all collectively have to keep pushing towards. So first and foremost, that's the most important. But I think in terms of, you know, when you do face trouble, I've spoken to a team recently. I try, you know, sometimes get calls from other teams asking for this advice, and I give them the same advice I was given. There was a friend of mine, Lawrence from Wildcat, had an exploit many years prior, and he said, you know, this is explained about all the difficulties, and said, you know, time is a great healer, so take time and breathe and speak to other people, because it's a very difficult industry to work in, but it is also a very forgiving industry, and there are lots of great people here that are there to support you, and everyone knows what a challenging environment is. So talking to other people and taking your time with things, I think, is really important. And you just have to be really tough and really resilient, because it's not going to be nice. But nothing worth doing is ever going to be easy, because if it was, somebody else would have done it already, right? So that's part of life, I think.
Awesome. Well, Michael, I mean, props to you for doing the hard things and pushing through. And yeah, I think it's a really inspiring story, seeing how, you know, you now kind of are bigger than you were before the exploit.
Thank you.
So yeah, congrats on that, and thanks again for joining me. This was fascinating.
Yeah, thanks for having me. Appreciate it.